Hey there. So I've been talking a lot recently over the past few weeks about the traditional financial story out there that you hear from the gurus and from the people on TV and from the self-help books for financial self-help, and they all say more or less the same thing. Spend less than you earn, save 10% of your income, invest in the stock market for long-term index funds or mutual funds, and then it'll all work out in the long run, right? Because there might be ups and downs, but over time, stock market, bond market, whatever, does well, and you provide for your retirement that way. So today I came across this publication by the Federal Reserve, and what they do is every 3 years they do a nationwide survey, and then they come up with a whole bunch of statistics that you can look at in these bulletins. So I was kind of browsing through here, and the main things I was looking at before was income levels, net worth levels, and then asset levels like uh, stock holdings and retirement accounts, that kind of thing. So if we look at the before tax family income, and all the numbers in these charts are already adjusted for inflation. So assuming you believe the government inflation numbers, which is a whole other story, but this is going to be internally consistent at the very least. So let's look. Why is this? It was loading just fine before, but now I have the webcam on and recording. What are you going to do? Okay, there it goes. I had to pause the video for a second. So here we're looking at the median value of before-tax family income for families with holdings. So each colored line is a different grouping, and this is by percentage of the income distribution. So the bottom 20% of the income earners, then the 20 to 40%, then the 40 to 60%, 60 to 80, 80 to 90, and then 90 to 10. They always have to break out that top 10% because the numbers are so different. It'll skew the 80 to 100 category. So you can see that since 1989, the top earners, they had a dip right here. There was actually a pretty decent sized recession going on with the S&L crisis and all that. And then we have the tech boom coming in here, the dot-com bust, the real estate boom, and then the financial crisis right here, and then we've had the recovery since then. So the top 10% has done pretty well. And what's interesting is if you look at these charts, so this is the median value, which is, you list out all the ones in order and you pick the one in the middle. And then on the following chart, we have the mean value. Now, the mean is much more subject to skew from high numbers. And we can see that those very high earners that are pulling the average upward, they are much more sensitive to the stock market than the median group. And I think that is because the high income median, the median of the high income earners are much more heavily invested into real estate and into their own businesses, which protects them from the vagaries of the stock market a bit. So, and then we actually look at that if we go down to the asset groupings, which we might do in just a second here. But the key thing I wanted to look at here was that if we look at the top 10%, yeah, they're doing okay, right? They've improved, and again, this is inflation adjusted already. They've improved over the past 20, 30 years, just on an overall trend. The 80 to 90% people have also gone up a bit, not as dramatically, but they have gone up. The 60 to 80%, kind of, sort of improvement. And then everybody below 60% is more or less flat. There's a little bit of waviness, but we can actually look at the numbers down here. So like on the bottom 20%, in 1989, 11.7 thousands of dollars of before tax income, and then 11, 10, 12, 13, 14, 15. Okay, so that's a little bit higher. The 20 to 40%, it's 27, hit a high of 33 and then back down to 31, and then the 40s to 60%, 48, 44, 54, 55, 52. So bouncing around a little bit, but not changing dramatically. And these people, the 20 to the 80%, that's the middle class, right? That's the great bulk that supports the whole financial edifice of the country. And they've gone pretty well nowhere over the past 30 years. And that's not terribly surprising. People know that, they can feel that in their lives. And meanwhile, the slice of the pie that goes towards expenses has increased. Um, in 1989, nobody had cell phone bills, right? Car leases and car payments were much rarer. So, um, you know, whatever you're earning, if a larger percentage of it is going towards bills that didn't exist before, then you're going to have less for yourself. So, student loans, revolving credit, car payments, cell phone bills, all these things we didn't have before. Internet bills, security systems, all these things, cost money, and people have made up the difference by, in large part, by borrowing. Whether like in the go-go days of the mid 2000s, people were borrowing against their home equity. Consumer credit has expanded dramatically. We've seen all the charts on that, passing over $1 trillion. So that's how people are making it work. But then the question is, does the standard financial advice work, right? So if you're in this, let's say you're right in the middle, you're in that middle group of 40 to 60% of the income distribution, how are you doing as time goes on? So with that, I was looking at net worth. Let's pause this here so it'll actually load. So here we have the net worth for families, and again split out by the same income distribution groups. And we see the top 10%, they're doing just fine. If you're in that top 10% of income earning, then you're at $1.5 million of net worth. If you're in the 80 to 90 percentile, 390,000. And again, these are in 2016 dollars, already inflation adjusted, blah, blah, blah. The middle class, well, if you're at the bottom of the middle class, you have gone from 45,000 down to 32,000. That's the wrong direction. If you're in the middle, 77 to 81, you had a good couple of years there in the middle during the boom days. Got up to 102 there, but then back down to 81, so more or less unchanged. If you're the higher end of the middle class, you've gone from 124 to 168, so that has kind of worked out. But even then, $168,000, let's say that's what you got, right, in assets, and that includes your personal home and all the other stuff, cars and whatever. So it's not really the same as yielding assets. That information is not collected directly, because if you look down at these categories, we can look at financial assets, but that includes like checking accounts and whatever transaction accounts, they call them, CDs. If you look at the charts for the CDs, they're all just down. Savings bonds are down because interest rates have been crushed for the last 30 years. Point is, if you're in that 60 to 80% and you have 168,000 of net worth, that's still not enough because you'll blow through that in a couple years. Or if you take the the 4% safe withdrawal rate, which I'm a little suspect of. I think 3% is a better number, but if you take that, 4% of 168 is not a lot. That's what, $7,000, something like that. Let's see. See my calculator come up here. 168,000 times 0.04, yeah, $6,700. So you have that. You have your Social Security. Your pensions are gone, but hey, you have your retirement, right? So let's look at retirement accounts, which are which are already included, but let's take a look at them. So here are the median value of retirement accounts for families, and again split up by the same income distribution sections. So yeah, $51,000 for that group. And you know, same story as always. The top 10%, they're doing great. They've expanded their holdings dramatically, and again, this is inflation adjusted, so this is real growth over here. But yeah, it's just you know, not a lot of money there. You know, Vanguard, they publish their statistics. You know, the mean, the average account value is something like 120,000, but the median, the number in the middle, is like 26,000. So, you know, the bottom line is that the money just isn't there. And you know, in my previous article, I talked about how it's the amount that you save and not the rate of return that you get, because you know, people always are touting like, oh, well, you know, I get 8%. I was talking to my buddy of mine. He says his investment advisor is getting 16% the last year. It's like, oh, okay, great. For the last year, that's one thing, but you know, can he give that up? Probably not. Just, you know, law of larger numbers kind of thing, and regression to the mean. But he's very excited about his 16%. So, but you know, how much are people actually saving? Not enough, because the savings rate in America is something like 2.5%, and you know, even 10%, not enough. You know, if you want to have a lifestyle in retirement that is in any way similar to your lifestyle during your working years. So this is just, you know, more a more detailed description that's collected by the federal government. Well, technically, Federal Reserve is not part of the federal government, but you know what I mean. Federal agencies, let's say, that you know, the financial approach, whatever it is, it's working for the top 10% of income earners. It's not working for anybody else. If you're in the 80 to 90%, it's working moderately okay. But everybody else is just treading water. So what is going to happen? We know that the those people who do have financial assets, who have 401ks and IRAs, the baby boomers are retiring. When you hit that 70.5 year, you have to start withdrawing, because you know, that was the deal with the tax man. So you know, it was tax deferred going in. Now you got to take it out, and you got to pay the taxes now. So that's going to be a drag on equity growth going forward. Interest rates, you know, what are they going to do? You know, who knows? I was just talking to somebody earlier about student loans. It's like, well, you know, do you want to go fixed or variable? Well, fixed is fixed, and that's nice, and rates are rising, so variable is probably not a great idea. But nobody knows exactly what the future holds. You know, what if rates rise to 5%? The economy crashes and the Fed starts cutting rates again. So it could go back down to zero. Maybe it'll go negative, like we've seen in Europe. So all this is a 13.5-minute way to say that the standard device is not working. So you have to do something different. If you want to be in business for yourself and develop that kind of asset, you know, that's what the rich do. And you know, do you want to be in that group? Or if you are going to work a job, how are you going to structure your lifestyle in such a way that you are saving and investing enough to provide for yourself later on? Because we know Social Security is technically still there, but it is insolvent. It is losing money at this point, and the projections are that it's going to run out of its previously built up assets by 2033, I think it was on the last report, and it keeps getting shorter, right? Because we saw that in the Medicare report, which is that same report that last year they said 2029, this year they said 2026. So what happened to those 3 years? Well, you know, earnings changes, demographics change, and all that kind of stuff, and it, you know, the assumptions get tweaked a little bit, and we end up with dramatic differences. So yeah, you gotta do something for yourself. So again, it's not the rate that you save, it's the amount that's more important. Now, if you have high rate and high amount, obviously that's best. But if you have to pick one, go with the amount, and you know, make sure you are saving and investing for yourself as aggressively as you can.